Lots of chatter about Canadian real estate market and what's going to happen. People are predicting, is it going to further slow down? Is it going to have a minor correction, or is it going to have a complete crash in the summer? Well, there are more than one factors that are going to play out, and one of those factors is the Canadian bond market. In this video, we are going to cover how the bond market is going to predict any major change in the Canadian real estate market in coming months, and what you should be looking for in order to be prepared for that. So without further ado, let's dive in. If you are new to my channel, my name is Yasin and I make these videos to educate my audience about real estate market in Canada, macroeconomics, general investing strategies, finance, and technical sales. If you are interested in any of those topics, feel free to subscribe. We are back to our topic of the day. So today we're going to talk about how the bond market is going to have a major impact in the Canadian housing sector. Well, before we go into that, let's understand how the bond market works. So bond is basically a loan contract between the issuer and the public. So in this case, the issuer is going to be the government most likely, and corporation as well. So but we consider government in this example. So the government, when they need money, they borrow money from the public. The way it works is, they issue a bond contract which has a maturity term, 5 years, 2 years, 10 years, 30 years. And the longer the contract is, the higher the risk it carries over. And in order to compensate that risk, there is a coupon rate is set, which we call yield. So the yield is set higher to compensate any potential risk on those longer term bonds. And the bond price and the yield are inversely correlated. Okay, so if the bond price goes up, the yield goes down. If the bond price goes down, the yield goes up. So that's how the bond market works. The bond yield is directly related to the fixed year mortgage rate. Okay, so keep in mind that. So what you're seeing on the screen right now is a 5-year Canadian bond yield performance, and you can see recently it has spiked up significantly, since February onwards. So what does it mean? First of all, let's understand that. That means, as I said, the bond yield and the bond price are inversely correlated. If the yield is spiking up, that means the bond itself is being sold off in the market. Why the bond is being sold off? Well, that means the investors who purchase these bonds have now less confidence to keeping these bonds as an investment. So when you have the inflation running hot, and I think pretty much every major economist believes that the inflation is going to stay, and when you have over 5% inflation rate, and the bond yield is giving you 1 or 2% return, it doesn't make sense to keep these bonds while the real rates are negative. Okay. So there could be other reasons as well, but I'm giving you a very simplistic reason why these bonds are being sold off. But let's just assume, if this is the reason, these investors are dumping those bonds in the market, which means, they are thinking of major economic difficulties coming along. And as a result of that, we see the spike in the bond yield recently. Now that spike in the bond yield is going to have a direct impact on the fixed mortgage rate. And if you look at all these 5 or 6 big major banks, all are changing their fixed mortgage rate very quickly. Right now, the fixed 5-year mortgage is sitting at 3.79%. And I was chatting with other mortgage advisors and consultants, and they were saying that they haven't seen a rapid rise of rates in the fixed mortgage category in their life. So this is something very, very important, and I think everybody should pay attention to it. Now, if that pace continues in terms of the yield spiking, I think in a couple of weeks, or maybe less than a couple of weeks, we will see the fixed mortgage rate will be crossing 4%. And if that happens, and if it stays that way, then it is going to have a major impact in terms of mortgage affordability across Canadians. Think about that. So even for the existing mortgage holders, if they are on 5-year fixed term, let's say if they purchased in 2018 or 2019, their renewal is coming up this year or next year. And if they renew it at a much higher rate, their monthly payment will jump up significantly. Now, this is independent of what Bank of Canada is going to do. Okay, so what we have seen, that Bank of Canada announced their rate hike program. They already increased 0.25%. A lot of major economists are predicting the Bank of Canada will at least raise rates 4, 5, or 6 times in this calendar year, which means, you know, we are talking about the overnight rate jump to like 2%. And when it happens, then the variable interest rate will also go, you know, around 2.5-3% by end of this year. So by the time Bank of Canada reaches that point, the fixed mortgage rate will already be much higher, and which is going to make the mortgage affordability very, very difficult for Canadians. So what does it mean? It means the mortgage market, the lending market, is going to be very, very tight. Okay, so the lending will become very difficult going forward if that continues. And when you don't have a lot of lending flexibility, then that means not much capital being flown into this market, and there will be less buyer who will be able to qualify for the mortgage and be able to afford the monthly payments going forward. So that is going to have a major blow on the housing market. When you don't have enough buyers who can easily afford the mortgage payments, you won't have enough buyers to bid for a $1 million property, for example. So that outlook is not very positive. Okay, now we don't know whether the yield that we're seeing is continuing to go up. It may come down, and as a result of that, the fixed mortgage rate may spike to 4%, and it can come down to 3.5 or 3%. Who knows? It all depends upon the economic situation, the market, sentiment. Because one thing we need to understand that, you know, this bond yield is a market sentiment reflection. Okay, the market already price in whenever something is going to happen based upon the news or rumors or whatever, or speculation. It already starts to price in, and the bond yield is a true reflection of that. So if we continue to see this type of movement in the bond yield market, which is going to have direct impact on the fixed mortgage rate, then we will see tough times for buyers to qualify and afford mortgage payments going forward, irrespective of what Bank of Canada will do. Now, if Bank of Canada is going to continue rising rates on, quarterly basis, then of course it's going to have another impact on the variable side of the mortgage as well. But I think before Bank of Canada do anything, the other factors like bond yield, or rising inflation, or rising gas prices and food prices is going to make the overall consumer life very difficult, because you will see the consumer spending is going to be reduced because everything is going expensive. You can see the gas prices, you can see the food prices is going up. Now, as a result of the war, we will likely see food inflation. Fertilizers, wheat, edible oil, these are the things that these two major countries export. And if we cut off the supply, then what's going to happen with the demand? Demand will shoot up, and the price will continue to go up as well. So we will see the overall inflation across the board. Food, gas is going to continue go up, for the rest of this year, and it's going to make consumer spending, I think, impacted big time. And as a result of that, things will play out for Bank of Canada before they do anything on the variable interest rate side. So that's my reading so far. I think time will tell. Nobody has a crystal ball, but I think the overall situation is not very healthy. The outlook is not very positive. We'll see how things will play out. But put your comments down below. Let me know what you think. And if you get any value out of this video, give me a thumbs up. And I'll see you in my next video. Take care.